the children of planet Earth. Hello from the children of planet Earth, Hello from the children of planet
What's up, everybody? Good morning. All right. We'll pre-market up in here. We got 2 minutes till market opens. All right, let me get my stuff going here. Ready to go. Music going.
Hello from the children of planet
All right. All right, take a look at the news this morning. See anything? I need to save that. Durables came out slightly ahead. That's good for August. Non-defense. Okay, take a look at this. Nothing crazy in the news or anything, so it's kind of a nice clean trading day. Opening inside DD bands. Market looking stable and interesting. Good stuff. Hit that like button, everybody. Welcome. Good morning. Just my inclination of what I feel. I feel like the market's still going to try to trade down as it's been trying to. I do think lower before higher. Now, the VIX has been decaying all night. So I think today is going to be a V-shaped kind of day. Volatility is going to kind of answer for itself still a little bit. Let's watch coming out the open. Resilience is pretty decent. 70. We're at the top of the box, gapping up a little bit. I do like it. All right, let's see. We get our liquidity maps coming through. VIX calculations coming through. Does our calculations show us? Here we go. Bears short up again. All right. Question is, it's the same as yesterday, right? Now, is it, do I want to play this? Hedge pressure break does go to there. DD is likely to be positive. We have DD band about 15 points away, so 20, about 35 would be the maximum high of day. High of day. Now, again, I don't bet on hedge pressure breaks, so what I'm going to do is I like to take that little dip case here, and that there's a possible support from here towards there. If RS stays positive, clearly we're going to, actually, sorry, do that wrong. From here to there. So it's not really actionable. What I hate about trades like this is that you're sandwiched. So I could take the hedge pressure long break to there, which I'll like to do. There is no shorting off. There's a possible short from here, but the downside is limited there. So in reality, it's going to be a flat, choppy day again. I'm like wider than normal. We have no VIX interrupts in the way, so it's SPY. Your zone is funky. I don't know. Have you logged out and logged back in lately? QQQ, same setup. Both resiliences are good, so it is one of those days where at least that's a decent trade. Yeah, just. The question is, would one want to short off a hedge pressure like yesterday's play? There's actionable here. Actionable here. So what we have across the board is we have resilience obviously being stable, support at half gap. We're gonna have hedge pressure as resistance. DD still bullish-ish, which means the market is still, it still has people holding the stock. You guys wonder, like, why is ED not showing bearish while we're still trading down? Because we're trading down in a bull market. This is something that's easily seen, that bulls are not selling their position. And commitment traders will show you that. The green line at the bottom is the asset manager institutional position. Typically your net long institutions, 401ks, IRAs, mutual funds, pension plans are all up in here. This green line is not selling. They are holding the fort. And so bulls are not selling. They're holding the fort. Not enough to kick it bearish. Stocks are still trapped in bull zones. They're still trading down in it. Let's look for illiquidity pocket bull runners today. I think we have bull runners set up. Let's see what we got. Anything good? Intel. Intel straight up, bear long up. Just hedge pressure support. Not entirely actionable here, so. The ideal setup today would be to fill the gap, the positive resilience to long from here to here, to get a nice little spread on that. Instead of taking a gamble right out the door, the inclination for me is to see the market be volatile, so I'm going to expect a big V. I'm going to trade that first V, get in, get out, call it a day. See if we can't get something good on that. All right, let's check this out. Get rid of these bullish setups. Actually, let's just remove that. Let's look for just hedge breaks only. That's what we're looking for. On the S&P side, hedge pressure break up. Oh yeah, let's look at IWM. Good call. Move a liquidity pocket. BLU. Oh yeah, IWM is looking solid. You got support here, support here. So in a best case scenario, right, whenever you know the market's volatile, I want that. It's the best trade you can get out of today, right? For bullish versus bearish filters. Wait, what are you talking about, Lee? What you talking about? Filters. Do not follow you. Okay, so what I want to do is, the question is, with rise greater than 0, this is a place to take a long entry from here, 55 to 57. It's about a 10-point move with a 10-point drop. It's about 1-to-1. I do want to let it pull back first to at least test the interface in the middle. Yeah, when you pick, anytime you add a scanner setting lead, like let's scan for liquidity map, for instance, you go into here, click this button. You can select which liquidity maps you want to scan for. Yeah, so when you select it natively, it says 0 selected. So like if you click this, you have some time, you have options you can add to further tailor your scanner setting. So if I want to search for like just the bullish ones, or just the bearish ones, I can pick whichever ones I want. You didn't know that? Well, you guys, did any of y'all know that? There you go. Okay. So right now, I just have particularly set up the bullish liquidity maps and hedge fisher break, but let's remove liquidity map altogether. And let's just search your hedge fisher breaks to the upside. So I want to make sure I take a look at that, because that's what we're looking for on Qs and S&P. So I'm going to remove VIX on the screen because VIX is not actionable anywhere. So we don't have any VIX interrupts coming through, which is good, which means I can take my long full term all the way till the end if I get one. Yeah, no problem, Lee. Appreciate you. All right, so I'm gonna grab a dep. Take a look at monthly maps real quick. As you guys see, this is really bad. Really bad. All right, let me start over. Not really bad, but longs, the market is reflecting that selling pressure, right? The monthly maps, the first time you see monthly maps like this is the uh-oh moment, right? Bulls are starting to liquidate their position. Bulls are finally going to start selling. This next command of traders is going to reflect that the next print. Bears, covering but shorting harder. The market is trying to wave down now. So that bull monthly map we've seen is now looked bearish. Does everyone see this? The fact that they both slope up is not a good sign for the market. Right? We've been covering this. Pretty simple monthly map predicts the future, and this is the best way to look at the future. It prints it for you on a chart. It's easy. It doesn't predict the future. Sorry, it reveals the future. It's not even predicting. It's showing you what is. Predicting would be a guess. There's no guess to this. This is exactly what you're seeing. This is the positional data shown out to the future, where all the options are planted, all balanced for time and price. The risk zones are shown here. If you're trading either in a bull zone or a bear zone, or as of currently right now, neither zone. So you see how we're trading like in a no man's land. This is the area in the middle is not bullish, not bearish. Let's start here. The area in the middle gets wider, its volatility increasing. Clearly, you can see in the short term, volatility increasing. So we're gonna have a volatile next week. Volatility up. Okay. So they're pulling apart or pitching together. Now let's move back this way. Are we trading in a bull zone or trading in a bear zone? Are we in the zone? Well, we're kind of in neither. So we call that volatility and mean reversion. Mean reversion means you're not bullish, you're not bearish. It's a liquid market that's slowly deteriorating into becoming a volatile market. That's what we've seen, a stable couple months, and then now it's starting to deteriorate. Okay, now the next step. At the bottom of the bull zone, which is the dark gray, is sloping up, which it is right here. Then bulls are exiting positions. So it's not only is it a balanced market that's deteriorating, but you have the bulls are selling. They're exiting. They're exiting very rapidly. You can see that. There's going to be a lot of selling pressure. If the bottom of the bear zone is sloping down or sloping up, which, you know, there's an inflection, does both. So the sloping down part is that bears are exiting positions. So in the first week, week 1, bears are also covering. Bears exiting. So you have longs selling, shorts covering. And that's just for 1 week. That's week 1, right? Because these are all the days in the future. Week 2 is you can have more shorting entering. So it's going to be this is very obvious read. Okay, you can see this on monthly maps. So monthly map is by itself is worth being part of Rocket Scooter. You can take any stock and see the future of it. So here's what we have. We had a balanced market that's deteriorating, becoming more volatile. For the first week, you have bulls exiting and bears exiting. So you have both sides exiting their positions, which is what makes volatility go up and liquidity go down. So liquid market, that was what we had, is now becoming illiquid as both sides are leaving. There's fewer traders playing the game. Fewer traders mean less liquid. More traders mean more liquid. Okay. If bears stepping away and then bears hitting it hard and then bears stepping away and then bears hitting it hard and bears stepping away and people are now going to step in and short this harder is what it's telling you. So a lot of selling pressure and double selling pressure. So the problem comes in the next couple of weeks. We're going to probably be lower we're going to probably be lower this week, mean revert, and then we're going to sell the remaining months of the year probably. That's what this is showing me. Now the inflection point here, they both point up, is double selling pressure. Bulls selling their longs, shorts shorting the market. You have double selling pressure. Double selling pressure is characteristic of bearish waves. If you go back to here, you can see this on the commitment of traders, wherever it be, is that in periods of both sides selling, I'll circle it right here. This is your long side of the market, your short side of the market, blue and green. When green is going up and blue is going up, like right here, the market goes up. When, like right here, when green is going down while blue is going down, you have short side of the market, literally from this inflection point right here. So when both sides are buying, it goes up, and both sides are selling, it goes down. Easy peasy. And this time, both sides are selling. So we're gonna have a choppy, wavy market. It's gonna trade its way lower. And monthly map shows you that. Look at that. And that's going until the end of the year. Good luck, team. Look at that. We don't guess anymore here. We read the market like a book. Can't this shit? Of course it could change. Anything can change. That's the whole point. The monthly map looked like this. The monthly map for the longest time had bull side stronger and bear side stronger as we rallied and rallied and rallied. And the moment we had the Fitch downgrade, that one day, this shattered into the nonsense you see now, which is that just random chunky thing. We could get a catalyst that comes up one morning, and we wake up the next day and everybody changes their tune. Those are the positions as of right now's current sum of all sentiment. Of course it could change the stock market. We're going to change all the time. 100%, yeah. And it is what it is now, based on now. For instance, if now you didn't do anything and the earth froze over like a ice age and computers went away or everyone died or something, there's nobody left but robots trading and options that expire and the system still stays intact. That would be what you'd see natively with no human choice making or changes or whatever. That's exactly what would happen. So, of course, anything can change because people can change their minds. You just don't know how set in stone those positions are. 100% set in stone. They're there. They are 100% accurate and they are 100% stone carved. Now, somebody can wake up tomorrow and decide to close their position, and then we'll read it tomorrow. Those aren't guesses. Those are exactly where options risk is showing positions to be at those points in time. And as people modify that, you get a read, but you get an overall read of what everybody's feeling by those trends. Both sides pointing up, both sides pointing down, etc. This is a trend. And the monthly map is all traders of that thing that exists. All the traders, as of right now's moment in time. So day after day, it can change, right? And you just have to read it every day to get a feel for it. Right now, it's not reflecting a strong bull market. It's only large bank. It's monthly maps. So we don't distinguish if it's a bank or an asset manager. It's a risk-based position that is believed to be held against any liquidity provider through mathematically derived. So essentially, monthly map is just like liquidity map, whereas what it's assuming for its zones, right? It has to meet a certain score of what we consider that the option is likely a hedged part of. Sorry, my thing is playing a commercial. Sorry. So that what happens is that I hate when the music just busts in with an ad in the middle of the stream. Or this one with Shopify. Okay, let me unmute it. Back to the music. Okay. So essentially, like every option that exists, our algorithm looks at that option and makes a determination. Does it belong to a dealer? Does it belong to a speculator? Dealer options are going to be hedged. So that's what makes hedge pressure so predictive of volume, because we filter out things that we don't think are going to be hedged. And so it falls under the spectrum of what that algorithm captures as belonging to part of a hedge. The option is going to be hedged against. So it's like the house's insurance. Yeah, can we look at USO? Sure thing. Okay. Bring it up nice and big here. And now you can see USO, like, and they're normally clean. As of lately, they've all gotten jumbled up because of the state of the market. So here we go. Look at this. Longs are digging in deeper. That's another sign of a recession, right? You know that oil and other commodities tend to be things people stockpile in inflationary environments in a recession. So the bull side sloping down means that longs are going to long harder. You see how that works? And you guys, y'all can, if y'all aren't part of the membership, you can go in there, and we're doing like this $35 special. You can actually play at the platform and play with all this for $35 a month. It's normally $200. So go in there for 3 months, do the trial, and you can just play with this for 3 months, see if you like it. Bull side sloping down, bulls are longing more. This is a still bullish pattern for oil. Bear side is kind of like chopping. These are weekly options. This goes out until the end of October. So for the next month, bears are also getting out of the way, sloping down. So you have both lines pointing down is double bullish. And bears over time are, while there's another wave like this, the general trend is that both of them are pointing down, right? Bull is down, bear is down, so oil is still going up. And that's what you'd expect to see in the same environment that we're in, trading in, I assume not, I hate to call it recession, but trading in like a second bear wave. If that makes any sense. Okay, so this is that actionable point. Today, resilience is strong enough to take a long at half gap. I still didn't take it because of the limitation at 428. Like I said, you know me, I want to get a nice, good trade that makes sense. I'd love to do a couple things. I'd love to long from here, if res is greater than 0, to there. I'd like to take a break play long to top a bear zone on a hedge break, which is again that 11% chance. We open below here, we're likely to close below here. So it would be something that would move probably like that. One that's on the short side can put an X there and short from here to there at maximum if res is greater than 0. Bounce. So the option is like being in the middle of two actionable points. So this is my entry point here. This is my entry point here. I only want a long, and I might actually, I'll soup along there too. So I got places in here to long from there to there. I got places here from short from there to there. And it's volatile, so we can pick one, right? Which one do I want to do? And I'm just going to wait for the action. Lee says, wow, amazing. You can figure that out. Oh, well, appreciate that. I mean, this is what happens when you're a board engineer and you need data to chew on. You try to become a little more data driven in your market analysis. So the things we created are very data driven, and I'm pretty good at making stuff that, like when I envision something, I'm good at making what I think. It's like some people can envision something and never, like somebody has an idea for a book, they never sit down and write it out. Or some people has the ability to build anything you tell them to, but they don't have the ability to see it. I have this kind of rare ability to envision something and then figure out how to make it work, or try to make it work. So these ideas that I had in the options world And I have a really strong team too that I work with. I mean, don't give me full credit here. We have a lot of smart people here. And then we just basically, the idea was if you can guess what's consistent in the market, what is it? Well, hedging is consistent. If you are a market maker and you get paid to make a trade, a liquidity provider, you get paid by the exchange to be on the books. You have a bid and ask. You've committed to a bid and ask, a tandem order that has you on both sides of the book, and that order gets filled. You get paid pennies on the dollar. They call maker taker fees. You can read about it. So therefore, you get paid to trade. So all you have to do is trade and then make another trade to balance that risk out, and you get paid on both sides because you're getting paid to trade. As long as each trade you make perfectly hedges the other trade, you're continuing to get paid to trade to neutralize your position. The more trades you make, the more money you make. The more neutralization you do, the more money you make and the less risk you take. It's free money in your pocket. So the theory is that market makers are going to hedge themselves to zero at all times because they get paid to reduce their risk. How about that? What a lovely game. I love it. So if we were to figure out a way to identify where that is, then the act of reducing your risk is going to not be the same everywhere. So at certain places, you're going to have hot spots of maximum risk reduction where you're going to be able to predict order flow because the hedging is maximized there. Maximum hedging takes place at hedge pressure. And so it just took us a matter of time before we figured out what consistently liquidity providers, because it's a bunch of independently acting entities, right? The answer is this. You have a bank here that's competing against a bank here. It's competing against a bank here. Yet they all are in the same kind of boat of doing that same drive your risk to zero. But they're all behaving differently. They're competing against each other, but they exist for a common goal. But they're not collaborating to do. They're competing with each other to do. Probably trading from each other to do. But the net sum of all their activity is to drive the risk to zero. So step one, identify those types of trades. And step two, aggregate them. And then map it out. And then use Black-Scholes to balance risk for all the different parts of the Greeks. Options have volatility, they have time dependency, they have a lot of things. And so you can take a risk. I can take your option that you're balanced out 6 months from now and assign it a risk parameter for how you're going to behave on it today. And then liquidity maps are born. I know it sounds like a lot, but from a mathematical standpoint, it's very simple for a mathematician to take that data and come up with a similar conclusion because it is consistent. And when you're looking for trading indicators, you want something that's consistent behavior. And this stuff all being algorithmic. This hedging is not somebody with the finger on the button. Oh, I'm gonna buy or sell here. It's all computerized. Computers are full time balancing that book out. Yeah, you were right about IWM. It's looking really solid today. So now at the end of the day, I'm spending most of my time here developing the platform. So I haven't really made any more cool tools since DD. But the idea was like liquidity map ideology was, could we create what is consistent in the market? Well, algorithmic hedging. Everyone's doing it. Those banks competing with each other are all doing it differently, but they all have the same goal. That's the best part. Now, Bank A may do something different than Bank B, but they're all have the same goal to drive the risk to zero. And therefore, at certain areas, their order flow is going to be maximized. And so hedge pressure was born from there. Liquidity maps, the zones, that's all a different algorithm. Then we focused on finding things that were future looking, just like this stuff was. And so resilience was born, DD was born. All these things are either arbitrage or future looking. So arbitrage is like the idea that SPY is tracking the SPX, and the SPX is equal to the market cap weighted sum of the stocks in that equation. So the SPY can trade on its own independent of the stocks. They can go down, it can go up. Anytime they go off kilter, there's like a rubber band that stretches, they're going to come back together. Resilience is an arbitrage type thing that's designed to understand that the SPY is overpriced or underpriced relative to the market underneath it. Here's a great example of this right now as I'm talking about it. For us to go less than zero, SPY is trading up here, market's going to reset. That's an easy to see setup. Everyone knows this one, right? So resilience going negative right here, market's going to reset. You'll see how this works. So this is from the resilient, and we give you little cheat sheets. And the other thing that I try to, that's very important to me, is being able to teach this stuff to, like, nobody wants to sit here and listen to some fucking nerd like me talk about differential equations. Let's go ahead and just put that aside. None of y'all got the page for it. Even if you're a mathematician, engineer, you still don't want to hear that shit. Trust me, when I was an engineer working for people, I didn't want to hear them be nerdy either. I thought the people I worked with were so nerdy, even though I was probably nerdier than all of them. I still hated my own kind. So let's make it easy to learn, make it fun to learn instead of make it grueling, right? Stock market is not a difficult thing. It's a bunch of random humans doing random things, and we're trying to derive some kind of behavior patterns from that, right? And the technical indicators of old would look at like shapes and colors and stuff, and it was really weak. Price action, we're looking at options. An option is you bought a contract. It gives you wouldn't own that contract if you didn't want some kind of gain or shares out of that. So, and your contract only has value on the very last part of the day, or it has implied value at this point. It only has value. Sorry, let me start. Your contract only has value at 2 points in time. When you, well, I guess 3 points in time. Only has value to you for 2 points in time. It's value to someone else when you buy it. So when you buy it, there's value that's set. It was someone else's value because they sold it. So your contract only has value for you at 2 points in time. Number one, when you sell it, it's assigned a value because money's exchanged. Number two is when it's expired, it's assigned shares. And therefore those shares have a value. Other than that, options are completely worthless, useless entities that have implied value throughout the time that they're alive. So the real value of those positions, not still open, right? So they have an implied value at some point in the future when they expire. And so, that was a very easy no-brainer that people that buy an option are telling you, I want to be long this stock, 100 shares at this price at this point in the future. Here's my hand. I've revealed it to you. And so it's like, well, how can we use that? These people are literally all, it's like a poker table, and everybody's put their cards down and said, I want an ace in the future on Friday. I want a king by tomorrow. And you know what everybody wants. And so it's the liquidity map and monthly map is like everyone's wish list, right? Literally revealed to you. So to me, it's like the strongest read of the market. Literally everybody is, because there's no lying there. You literally own an option there. The lying is, if you lied, you still had to buy it. And then if you were lying, you would sell it before it expired. So the idea is that you've got a full reveal on what people want to do and what people are currently in. It's great. And so that was a huge driving force for us. All right, so making it easy, right? Let's talk about it. Give you little cheat sheets in the Discord that kind of make it easy to understand the relationships. I was going to pop out resilience real quick. This is very important. Resilience is our gap fill predictor. So the S&P has gapped up overnight. This is yesterday's close. This is today's open. So we're trading in what's called the redistribution zone, as the open and close is also guaranteed high volume. All of our stuff is predicting high volume. Hedge pressure is hedging volume. Open and close is that volume that the market maker takes on those MOC, MO orders at the end of the day, beginning of the day. We gap up, we trade here, volume and volume. So these are volume pivots. Open and close always are. Redistribution zone is if there's an order imbalance at the open or close of the day. The dealer is going to take the other side of the position and then redistribute that position throughout the rest of the next day. Example is market's trading down, boom, you close. And you turn on CNBC and they're like, well, we were looking today and the S&P had a 300,000 share sell imbalance, blah, blah, blah. Okay, so the dealer bought this 300,000 shares. And then the next day, they're going to gap down and they're going to try to, or gap up, and whichever one they choose to do based on that imbalance. And then they're going to try to redistribute those 300,000 shares to everyone else. Are they going to find buyers and sellers? We know where they are. The open and close are where buyers and sellers were previous days in a new day. Huge amount of orders there, huge amount of orders there. There's buyers and sellers at both places. So pivoting between them is a very logical conclusion. You see that open and close on any stock, anything, always is an actionable pivot. It's always got a volume spike. Anytime you touch it, volume spikes. There it is on my screen. Okay, make that a little bigger for you. Let's make this one bigger. We're talking about this one. Anytime you touch the open and close, you're going to see volume spikes. See, all of our stuff is predicting where volume will be. Volume pivot. There's volume spike. Volume spike. And then anytime you're going through open and close, you're going to see some volume spike through that redistribution. So what resilience does is it exploits the idea that the S&P doesn't want to doesn't want to deviate too far from the stocks it's tracking. The SPY, sorry. Now the SPX is equal to the sum of the stocks, but the SPY is equal to the SPY's own price based on its own supply and demand, independent of the other things. But when left to its own accord, SPY will tether itself to the SPX. It's designed to be priced and pegged to the SPX where it tracks it. So if both of them are just trucking along, stocks are all trading sideways, and S&P is trading sideways, and all of a sudden somebody starts buying the S&P out of nowhere. Well, the stocks, and let me start over. Somebody starts selling the stocks out of nowhere. This is SPY. And the stocks are selling. Now, SPY has one of two things. SPY can natively, it's going to start pricing lower to match some of the stocks, even without any orders. But what if people are selling the stocks at the same time somebody's bombarding the SPY? Well, SPY is going to go up even if the stocks are going down because it trades independently. But it's stretching away from its native desire to track. So the moment that abnormal buying pressure subsides, you've got two things that are stretched apart that want to be close to each other, right? So one of two things is going to happen. Either the stocks are going to rally up to meet the SPY, or SPY is going to sell off to meet the stocks. And more often than not in rational market, this one moves to meet that one once the buying pressure sells. That rubber band snaps back into play. As I'm talking, it's happening. I love it. All right. Jeez Louise, it's so fucking easy sometimes. I love it. I love when I'm teaching the lesson and then it just boom, there it is. Okay. All right. Oh my goodness. This is like. Okay. Anywho. Long story short, you can't predict which one's going to go to meet the other, but you can predict the arbitrage setup is that if SPY is moving up and stocks are moving down, then you have basically the easiest set of choice in the world. The probability is that these two things come together, as the Beatles would say. And so what you do is, it doesn't matter which side you pick, but as long as you short the SPY in this opportunity and long some basket of stocks, if you had an equal basket of stocks equal to SPY balanced out, then wherever they meet in the middle, you win on all fronts. As long as both of them end up inside of here, you win both of those trades. What you wouldn't do is long the SPY in that situation and short the stocks in that situation to bet that they diverge further, because at some point they're going to connect. So the arbitrage is to say that they bring themselves together rather than they push themselves apart. So the exploiting of that arbitrage is saying that what resilience is telling you is that the stocks themselves are fluxing through their half gap to fill the gap that way. Yet SPY is trying to trade this way. And so once the stocks lose their power and start fighting with their half gap and then dying, which is what they did right here, SPY is now on a journey to fill the gap that way. This is a perfect arbitrage opportunity, and this is why resilience is the best leading indicator on planet fucking Earth, because it can reveal these things to you. And if you don't know what you're doing right now, an average trader would say, oh, there's a dip to buy. I've been waiting along all day. And right now, Papa Bear is saying SPY is on its destiny to fill the gap to the downside. If you don't believe me, this is exactly what Mode 2 Redistribution Zone Negative Resilience tells us. It's in the cheat sheet. You have three different ways this happens. Number one, SPY is trying to move up, and resilience is dropped below zero. It's losing steam, and then right here, it's dead. Literally right here, it's dead. Immediately, if I was in a long, I would have exited. This is why I didn't long to begin with. I saw resilience decaying quickly. I was a little nervous about it. Now, again, the pivot goes from middle to here for as it's greater than zero, middle to there for as it's less than zero. It's a scalper's paradise. If you like scalping or scalping the intraday, resilience is one of the better tools there is for that. It's my favorite tool, by the way, so I use it for so many things. Middle tie breaks to the downside. If res is less than zero, check. This case doesn't apply because we're in the box. If you're outside the box, it tends to be a fake out and it fills out. Here's your fake out today, right? Now, again, there was no indication it was selling off, but when I drew my trade plan today, my actual pivots are either here or here and here. So I was either going to long from here with res greater than zero as a condition. You can rewind to see that. Remember, I don't trade noise. I trade actionable stuff. So I sit out on the noise. I'm really good at identifying that. Or I'm shorting here, my two options. So now that we've arrived at my destination, Ladies and gentlemen, what I long here, you read my mind now. Tell me what you think. Where are these resilience charts available? The cheat sheet is in a platform features overview section of the Discord called Cheat Sheets. Would I long from here? Would I do anything from here? Everybody go to Cheat Sheets. If you are a member here, we've made you like all kind of help section. There's a couple things you can do. Learn to trade, all of the boot camp on how all these you can trade. In general, trading education there, but this is like a glossary of all the terms. Here's all your cheat sheets. We have infographics for each one of our tools that explain them with like very simple cartoons to make it very easy to understand the rules. The colors are position size metrics. So like green is a normal position, red is a irrational, yellow is a caution. It's position sizing. It's written in here. These are different things that can happen. These different, Ashton made some for options trading. So like how you would structure, I think this one is like how you would do options selling on the bull side, and then where you'd enter and exit options trades. So kind of like they're basically some guidance sheets we made. They tell you how to read monthly map. They tell you how to read resilience. This one tells you how to read the overnight dynamics, etc. All right, so I take a guess here, and you know that I do not want to long this from here because of that. I also don't want to short it either because my short action points are only from hedge pressure. So here we go. Here's a prediction. We're going to there, and I'm going to sit out and miss it. I still don't take every single trade I can predict. Even though most of them I do see, like yesterday, I go, market's falling, I'm going to let it fall. I still take the highest probability trades. I like to maintain a high win rate and strike hard, as they say in Cobra Kai. Strike first, strike hard, no mercy, sir. You got to get in and get first, jump in on it. When we hit that lower gap fill, I'm still not going to tap it. So this is probably another sit out day, which is great. I like to only take good actionable trades, and I'm starting the small account challenge again. So, I'm going to be very, very not so gambly. You see, I get serious whenever I'm trading. I'm super serious. I'm very picky. And picky is the best way to go. Trust me when I say, pick your favorite guru out there. I'll trade circles around them. Pick anybody that you know. Anybody. I love competition. I definitely would challenge anyone to a trade-off. I will not only out-trade anyone probably in social media that streams, tweets, whatever. I'll run circles around them 5-10 times over. But that's because I don't trade a lot. And almost all of them do. I see people, streamers up there trading every single day. They're up, they're down. It's just gambling. But in reality, you'll see me like tortoise and hare. You'll see when I strike, it's like I'll jump ahead. Like, wait, what? Because I wait. And you can do that too in your trading. Don't try to trade everything that moves. Just wait until things line up and then strike big. When your confidence is big, strike small when your confidence is small. Even if I could predict it's coming down today, I could jump in and scalp that, but the part of a small account challenge is to show what you would do to appreciate a smaller account. And it's not taking everything that moves. It's your first couple moves out the door have to be your best ones. I'm very confident in your setup and take a good one. And try not to trade every day because you just get emotional fatigue. And you don't want to, it's like pitchers on a baseball team don't pitch every day. You're going to fatigue if you do. And break his leg. Break his leg. Put him in a body bag. Yep. As you guys nailed it, you get pinned down with the trend. So, anyways, just being silly here. I'm just very cautious when I trade. I don't really give a shit what other people do. But y'all watch other people, I don't. But I'll tell you, the difference between me and them is trading pays my bills. A lot of them, YouTube or Twitter or other things pay their bills. For me, if you want trading to pay your bills, you need to be picky. You need to be cautious. You need to treat the market with respect and not trade every day unless you are convinced that something's worth taking. You don't go buy a house every day in a good housing market. You need a good deal, a good time, a good investment. And even though the last 3 days you've seen me predict the direction almost to a T, almost exactly. Monday was a choppy shit show. I said I'm probably going to go up and not do much. Yesterday I said the market's going to hit hedge pressure and probably come down. Today I said the market's likely to have actionable pivots just here and here. I'm not going to trade till I hit one of them. And so you can see that I have a very good grasp of the market as a trader. It doesn't mean that I still go in and try to make something happen every minute of the day. Protecting your capital is the trick to doing this for a living. You hate your work, you hate your job, you're gonna go, throw out your stuff in your boss's desk, tell them to fuck off and go have the life you want and be a full-time day trader. You're not gonna go home and start pushing buttons every morning and playing the stock market like it's a video game. You're a fool if you do that. You're gonna go home and you're going to preserve your investment. You're gonna think before you act. You're gonna think really hard before you push that button every single day. Good oil inventories in 20 minutes. Yep, we have the EIA data coming out. That's gonna, in my years of trading oil, I found out the EIA data it's like sensitive in certain times, not sensitive in other times, and it's a hit or miss thing and a predictability. Obviously, oil looking with a bullish liquidity map and bullish monthly map, any builds that you see in inventories is likely to be very bearish against a strong bull market, at least a bear knee jerk. But then again, I've always seen those EIA reports come out and the market just half the time did something completely different than you thought. So it's just kind of saying that, people, I think actionability, other than sparking some immediate volatility, people already have their minds made up before the report comes out. Magic keeps spitting wisdom that's hard to find nowadays. Well, wisdom, see, here's the thing, right? Defense wins championships and offense gets views. I don't have 10,000 people watching the stream every day, but I have 100 and something people currently in the stream now, half of which sit at home and day trade for a living. The difference between me and that other stream is a bunch of a bunch of maybe mixed bag of different folks. People that trade, people don't trade, people want to trade. But defense wins championships. This is where the real wins happen. There you go. And as you can see, you can rewind the stream to the point that I showed this is going to happen. There's your resilience, guys. And the difference is that it's really boring to think things out, and it's really exciting just to watch people push buttons. However, for me, I like reading books because I learn something. I also like action movies, but in the right context. This is not an action movie. This isn't John Wick. This is a philosophy exercise. The best loser wins. A great... Oh, dude, I like that. I like that sound. Being caught. So what do? I'm at my potential entry point on the long side. Resilience less than 0. I'm not going to touch it. We see how resilience was so actionable. So predictive of the stock market's action. You can't get any better than this. I'm literally teaching the lesson, and live it shows up just like one of our cheat sheets. This is a really strong tool. Now anybody can long from here on risk and reward to bet that resilience heals itself. Not a terrible idea to take any trade off of any point. Now the question is, do I still want to long? With the resilience being less than 0, I know the probability is really high that I lose the trade. But also the reward to whatever risk I set is also pretty good. If I did want to long, I could set, this is at what, 426 and some change to 428. I can force myself to set a 2-to-1 trade. Now I know I'm committed to the entire day to do that. It's not going to rally there in a minute or two. It's going to take hours to do that. So my next question is, do I want to spend hours on a trade, or do I want to go play Zelda Tears of the Kingdom for 2 hours and come back and do a Zoom call? And figure out what I want to do with my morning. Could you check? Yeah. So ideally is like, now that I'm at my action point, do I want to actually take it? Probability is really high that it goes against me. Or Starfield, that's what I'm talking about. Yeah, dude, Tears of the Kingdom. I don't get a lot of time to play it, but I'm obsessed. It's just such a mindless, peaceful, I do a lot of peaceful shit in my life these days. My life is very chaotic when it comes to developing a platform and running a company and running. 25 people work for Rocket Security now. 25 people. You believe that? Last year it was like, when we launched, there was like 12. And then the year before that, there was like 5 of us. So I gotta do things to like lower my blood pressure and peace out. I garden. I'm an avid gardener. I've got a kick-ass garden. I do yoga. I work out. And I like doing like mindless adventure games like Zelda, just like running around the mountains and shit, just to kind of chill. Zelda's great. The new Zelda's formats are just amazing. I'm not like a super gamer these days. I'm super busy, but if I ever got to kill an hour or two, I'll get my laptop on the couch while I'm answering y'all's question, Discord them. It's a mindless game going on. All right. What's your question? It's taking you way too long to learn this kind of patience you talk about. Your old days and your previously blown up account would just jump in willy-nilly. Patience and control are how you do this for a living. The only thing you can control is how much you lose. That's your one control point in the market. You literally have full control over how much you're willing to lose. That's the best part. People think the market is, your stock market and your behavior is completely random and your outcome is random. It's not. Half of it's random. You can't control where the market goes and how. You can't control if it goes up, goes down. You can't control any of that. But you can't control when you pull the plug. You have 100% control over that. No matter what the market does, catalyst, no catalyst, people doing whatever, you have full control of how you lose. So one half of the equation. Oh, and you have full control when you enter as well. So, but when it comes to money, you have no control over how much you make. You have full control over how much you lose. So when you enter a trade, you have rigidity on telling yourself, I want to lose here because I'm confident I'm wrong there. And I don't want to lose any more than that. And this is how much I'm going to lose. Set your position size. So because you have full control of how much you lose, it anchors a position size based on how many points you think you're going to want to pull the plug. So you now can anchor the entry point of your trade with full science, which is great. And then you're just gambling that something happens and goes in your favor, and you have varying probabilities of which one's more likely. And all of a sudden, you don't have control over any of that. And then you have to play the game based on how do you feel your confidence has changed as you get to each of those places. So it's very simple. Like my entry is, should I long here? That is normally one of my entry points. My confidence is very low. The reward to risk, I can just set arbitrary at 10-point stop to get a 20-point gain. It's 2-to-1. Okay, it's good, but to move 20 points against the herd against resilience is an all-day trade. So check, I got to wait all day to get it. Number two is the risk and reward is pretty good, but I'm confident I'm going to lose. So it's probably not a winning trade. I'm confident I'm going to lose it. Maybe I do want to take it just to have something on the table. Therefore, with my confidence high that I'm probably wrong, I would immediately take a small bet. Do y'all see how that works? It's as simple as that. I'm looking at QQQ. It's the same thing. They're exactly the same. It's on the screen. Oh, it's the same setup. My bad. I got you. It's the same thing. And the resilience is negative there too. The same exact trade. My bad. I'm sorry. No, I didn't address QQQ. That's all on me. My bad. I love you, MK. You know that. So because I'm not confident that the trade will go in my favor, my confidence is low, my position size is small. Smallest you can go is 0. So 0 is good. If I wanted to take a stab at this, I'm betting that the market moves higher and resilience comes above 0. This is the good entry point for that because I'm not super concerned or convinced. Say that I wanted to make a trade. I definitely wouldn't trade a mini. I would come in and trade maybe a micro, right? Say that I wanted to come do this, right? Now I can say, oh, okay, you know what? Maybe I can just, but, oops, my bad. That's not what I wanted to do. MES Z23. Okay, good. Right one. Star. I keep forgetting to hit the star. There we go. Okay. So if I did want to take a trade just because R&R is good and I know that my confidence is low, then I just bet small. Like a micro or two, right? Just joined a couple days ago, Numeric, going through all the features of the platform so far. How you liking it? Hopefully you're digging it. Cool. You'll find that's different, but different might be good for most people. So let's pretend that if I were to make a bet right now, I'm going to bet that resilience heals itself and say I wanted to jump in on a micro. I would just click the button and hit a micro. I still don't want to do it. So even though it might be a decent gamble because you know that your probability is lower it's not super confident that it does work. You can still see that there is a bounce point off of that entry point. Anyways, it's just right now they're starting to stretch again. Oops. The SPY is going up when the stocks are pushing lower. So SPY is going to want to reject these areas in the middle. It's going to be a fight. So if RES less than 0, we can resort to our cheat sheet again. It's going to be resistance there and resistance there. So the best I usually hope for is that when we get there, I examine resilience again. If it's still less than 0, I'd actually close out and not get the full 20. I would just scalp from here to here. We had a video on scalping the other day. Actually, I need to post that up for you guys. So now that I know any longs I do take are going to be very short-winded. There's going to be resistance here, resistance there. But we always talk about if there's at least 1 point of difference, it's good to scalp redistribution zone. I have a whole technique on it. Just to trade from here to here, there to there. You consider UVXY half gap is partial bombs? That's a good question that people have always brought up. And as of this point in time, I don't have an official rule or strategy that utilizes the redistribution zone on UVXY, but it begs the question, right? Let me ask you guys, should we contemplate making something from that? We know that anytime VIX can bounce off of a potential target, if it hits a hedge pressure, monthly hedge pressure, or bull zone bottoms, we know that volatility could be imminent, right? So the question becomes, should a volume pivot that's bullish, clearly we use that as a rule in VIX. Okay, volatility is likely to go up when you bounce on hedge pressure, bounce on bull zone, but those are bull pivots. The open and close aren't necessarily bull pivots, they're just pivots. We don't know how it behaves because we don't have a net force at each one of those. The difference between open and close pivots is that the force only applied once at the open and close of the day. It's not like a consistent pressure built on options that expire months out. Like hedge pressure is based on the landscape that exists for months, right? That's a really strong case for a bear push or a bull push from hedge pressure being above or below it. The opening and close is a one-day event. And that position is usually redistributed that day. So the question becomes, how strong are open and close pivots on VIX that we can create something predictable? Clearly, you see where my mouse is. The open and close are high volume pivots in the half gap, just like you'd expect. You expect open, the half gap, which is halfway in the middle, and close to be pivots, and they are. But can we predict that? The question is, what he's saying is, if VIX hits here, can we predict that that's likely so that we can get out of a long trade? That's exactly why you're asking that, right? Because I know that you're thinking the way you're thinking. And the question is, can we create a tool that allows us to pivot VIX one way or the other? Like clearly at resilience, we have a half gap pivoting tool. Now, if I was long right here, I'd exit my long right there. The hypothetical micro trade I could have taken, I would immediately be out of that trade right now. This is unusual against the stretch of where the market has deviated. He says a lot of unusual volume there. So if I would have scalped on risk and reward, I would have taken that. Again, I'm choosing not to trade today. Small account challenge. I don't like to do scalping a lot until I build some fat in the account. So I tend to try to check out a really strong trade or two out the door. So the question becomes, if VIX hits this, do we consider that a possible bull bounce, even though it's a pivot? Now with resilience, we can hopefully pivot the market one way or the other with using arbitrage, because SPY is tracking a basket of stocks, like indirectly tracking a basket of stocks. UVXY is tracking the VIX, and VIX is tracking, so UVXY is tracking the VIX, and VIX is an equation. It's based on the options in the SPX. It's not as straightforward as creating an arbitrage indication of UVXY stretching away from the VIX. The VIX is not made of tradable components other than options, and options can gap up or gap down. And so therefore, to have like a UVXY kind of resilience to predict up or down pivots, you'd have to actually like create an arbitrage indicator that's a sum of all the options in the SPX and the window the VIX looks at, because they also gap up and gap down. They're just not going to be as not going to have imbalances like they do at the end of the day. So the question is, can we create a tool that predicts, is UVXY going to bounce here on that bottom line? I'm just thinking out loud. It's a great question. Would we consider this a bull pivot? We would consider it a pivot. To lean at bull or bear, we need some kind of thing, right? The SPY, we lean bull or bear because we can sum up the stocks in the basket. Do we lean bull or bear here by summing up the options the VIX looks at? That's a very, very, very sophisticated calculation to predict VIX pivots in the redistribution zone. Predicting VIX is very hard for that particular reason. Day trading against volatility, this complexity is just immeasurable. Could we just arbitrarily say that this is possible pivot on the VIX? And the answer is an anecdotal sort of thing. You always pivot at open and close for everything. And VIX clearly is pivoting there. Do we have any way to tilt? What's the probability it bounces up versus breaks below? How clean is it going to be? The answer is, as of this point, I have no clue. We don't have a rule for it. I've never utilized that, but it is not a terrible idea to say that VIX could bounce here, therefore I'd exit along. We know for certain, again, anecdotally, that VIX bounces off a hedge pressure 90% of the time, like all other hedge pressure bounces. And we know that VIX will hold the bull zone bottom majority of the time as well. It will bounce there. So we see that, and that's why it's a rule. Now, the way that you make this a rule is not by trying to create, like I said, the sophistication of inventing a tool on a theory would be an insane amount of work for the gamble that it shows something. It's better to solve problems like that anecdotally or empirically. Watch it, and you come up with an idea as you watch it. Give it a week or two, you watch it and report back to me. Matt, I watched it. 40 of the days it bounced, 10 of the days it didn't. Okay, now it's worth investigating. Okay, now let's build a tool. Let's try to see if we figure something out. So the answer is, I think maybe we never explored it because the VIX is a little harder to predict than stock market is. And it's a lot of work to do that because you have to create arbitrage. You'd have to literally sum up what all the options are doing, right? And how consistent is this? If it's near the edge, like 40, 60, 50, 50, then it's not worth it. But if it's 4 out of 5 times, 5 out of 6 times, you at least get 1 solid pivot or 5 solid pivots. What can you notice that's a pattern? How often does VIX like to bounce off of its boundaries? And that would be something that would invite us to explore creating a theory and then creating a tool, because the evidence states that there is some kind of relationship, right? So we're going to use old school scientific method here, figure it out. So probably the only actionable scalp would have been from here to here today. It's predictable. If I would have taken push the button on micros, like I said, I would take a very low probability micro trade. Once you get to each one of your spots, you got to analyze where resilience is, and you can look at it and say, oh, hell no, right? This ain't working. So I would exit my trade literally right up in here, right? I would scalp from here, I'd walk away. You see how it's kind of cool, like had I pushed the button on each one of these trade setups I was talking about, had I shorted to fill that gap, had I take a little tiny long here and close right there on a 1-2 hypothetical trades. But in reality, the market's jolting around. I don't scalp that much at the start of a small account challenge. But I think in the future I might demonstrate some of those trades. I like to talk about them, like I can see them and call them before they happen, but I don't like to take every trade that moves because I want to maintain a high win rate out the door. Kind of keep that drawdown small. Oh, nice job. Nice job. All right, you here? All right, you guys, make sure you follow, subscribe to the channel. We love you. Follow us on Twitter. We love you. Join the Discord if you want to check out the extended trial and play with these tools. Feel free to let us know. We're glad to have you join us. Our tools are much simpler to understand and use than majority of trading analysis tools out there, simply because each tool has a specific purpose, not infinite ways to analyze it. You can put moving average on a chart and you can analyze it completely differently than everyone else around you. A million people will look at it a million different ways. However, you will look at each tool one way. It's designed for one function and it never changes. Everybody in the middle of half cap, when resilience is less than 0, will understand that the market's more probable to go down, or probable it goes down than up. There's no question about that. So it's not like the tools are open to a bunch of subjective analysis where you have to go out there and study a bunch of different ways and, well, maybe up, maybe down. Oh, RSI is 30. Okay. Oh, it's 20. Oh, is that oversold? Should I buy? Oh, it's 10. Okay, well, that's more oversold. Maybe I should buy. The other guy said 10, and then maybe 7's my sweet spot. You're constantly you're creating your own way of seeing something. It's very loose, and it's not effective for a new trader to have to create their own controls. If you ever if you ever go buy tools from people like indicators and stuff, Ninja Trader ecosystem is really, really bad at this. They have like just this like cesspool of indicators. It's just bajillion them because it's one of the oldest ones. And so they've basically collected like all, it's a sponge for everything that exists. And there's a bunch of junk out there. And I was like, a long time ago, I just remember you download somebody's tools and then they send you like tuning parameters. My funniest, favoriteest thing to make fun of your trading gurus of the world are tuning parameters. Here's an algorithm that works, but here's the thing: you need to go change these parameters every once in a while to retune it. Well, it doesn't work. You're just it's curve fitting. They're just watching the market and then adjusting their tool to match the market. You're literally buying price data recycled back on itself. You're being scammed. It's like tuning parameters are a scam. If you have to download or install or go retune your indicator, you're being scammed. 100%. I'm a mathematician. I'm telling you straight up. It's called curve fitting. Oh, the curve is not working, but here, add these numbers and it'll match again. And then it doesn't match again. They give you the new numbers. You're constantly chasing your tail. So tuning parameters allow infinite flexibility of an indicator. There's no flexibility here. They're not retuned. This is the same read every day. Resilience does what resilience does. As Forrest Gump would say, resilience is what resilience does, or whatever he says. Okay. It's the same exploit no matter how you look at it. Numbers never change. And you see on my screen, I've got the red one up. It is pointing down. You see all this resistance pressure there simply because the line is less than 0. Or the value is less than 0. You don't have to constantly retune your parameters or reshape your tool to match varying market conditions. If you're a good programmer or a good creator, you would create something that's robust that can stand inside of all market conditions and not need to be tuned to match different environments. That's just the failure of technical analysis to begin with, the curve fitting aspect of it. You have to analyze it and shape it to match the price it's supposed to track, and you're just forcing it to match, and that just doesn't work. Got the bottom, nice job. Okay, explain the yellow resilience, please. Okay. So resilience is the tiebreaker at half gap resilience. Okay, so at the white dash line, it's a pivot one way or the other. Half gap resilience is what we call it. We just call it resilience by itself. It's the full name of it. Its first name and its middle initial is HG resilience. Well, that sounds like an author that wrote fantasy books. HG resilience. It's a cool sounding name. Kind of reminds me of H.P. Lovecraft. All right, here we go. When you get to here on the times you are there, the minute you're here on the SPY, you consult this to see, are the stocks doing that or the stocks doing that? It's that simple. Just like when you're at half gap, you consult this to see if the stocks are doing that or that. So half gap resilience pivots the open and close in the box, or it pivots off the close to an indefinite spot that you can't predict, and it pivots off the open to a different spot. So what the white one identifies is pivot here and here, and the pressures towards the middle, from the middle, and off the box. That's it. The yellow is just pressure off the line to an indefinite end. You can't predict. It doesn't bounce between anything. It's just give or take. So when you are here, it's a similar aggregation method that when you're right here. It's now time to consult the stocks. What are they doing? The majority of the market cap is fluxing away from this delta positive, positive delta hedging, then the S&P is very unlikely to collapse under its own weight and crash if the stocks are holding. And that's how the same pivoting magic you see with resilience, with half gap resilience, you'll see the same thing. Now, everyone take an analysis right now. 98.9% of the S&P stocks, that's not 98%. It's the scale is negative 100 to 100. So it's 98% this way. So on a scale of 200, you have 198 divided by 200, which is still close to 99. So 99.5% of the stocks are above their monthly hedge pressure right now. So the majority of the market cap of the stock market is still on a monthly basis, which expires 10/20 for the course of this month, is still gamma positive. The options are still we're still in a buku amount of calls in the money situation. The DD ratio is showing the same thing. This is all options that exist. This is the monthly. So when you're near the monthly hedge pressure, like some points in time as you get closer to expiration, you will see monthly and price will be closer to each other and it's more actionable. When you get to monthly and you see your liquidity map has pivots off of it. So here's an example, bear short up. Imagine that you fall right here and your literally market is right there. Okay. Oh, okay. Well, look, I can long from there or it can fall through and break. Which way do I go? And then this is my tiebreaker. Well, I'm definitely going to buy the dip. Consequently, if you're trading right here and monthly resilience goes less than 0, I'm going to get away from my trade as fast as possible. I'm not going to bet that we crash through it and collapse the market, but I'm not going to bet that the SPY continues to rally if the majority of the stocks are starting to capitulate on a monthly scale. And that's massive hedging. Monthly hedge pressure breaks are one of the scariest things you'll see. They're very rare. I bet you if we scan for it right now, they're not. Hedge break in general is like 11% of the time we see that happen. And they're even rarer when you are closer or when you're farther away from monthly expiration. Let's go ahead and scan for some. Monthly hedge pressure break in general, there's probably not that many of them. Look, there's only 5 total. I haven't even heard of half of those companies. Monthly hedge pressure breakdown. How many have broken down? 3 companies. That's it. How many have broken up? Probably none. Or maybe a handful. A little handful. Oh, I look 32. Okay. So either case, there's not that many, right? You have hundreds of, 505 tickers in the S&Ps. You're talking like 5 stocks and 30 stocks. Not that many, right? The majority of the market cap it's not big hitters here. These are all baby stocks, so nothing big here. Maybe Disney. Okay, so Disney broke up. No, I'm sorry. Don't listen to me. I picked the wrong thing. I was like 30. That is a lot. Okay, I picked the wrong thing. Don't listen to me. This one. That's more like what I was expecting too. Okay. There's 5 and 2. That's it. Jesus, I was like, wow, there's 30 stocks. Okay. I picked the wrong parameter. I picked half gap break. So in general, 2 stocks have broken up. Okay, that's not a lot. Monthly hedge pressure breakdown. Like 3 stocks have broken down. There's no stocks are traversing that line, right? They're not jumping from one side to the other. So if you start to see stocks hitting their monthly hedge and falling, it's another balancing act that you only use a monthly hedge pressure itself. On the SPY, NASDAQ also has one. So at the start of the month, right, the start of the trading month, which is pretty much closer to now, the Monday after the 3rd Friday of the month is your start of your trading month. So it was like September 18th or whatever. Monthly hedge pressure is usually far away from price, whether you're bearish or bullish. This is bullish structure for the month. If you're in a bear market, monthly hedge pressure will be above. As the month goes by, monthly hedge pressure will creep its way closer to price parabolically like this. So if like SPY were to hold flat between now, and October 20th, like here to October 20th, if SPY were to hold flat, then as the days go by, monthly hedge pressure all things being equal, will decay rapidly towards price. And the last week of the month, you start to see monthly hedge pressure be more actionable. Now, that's just a generalization of a really strong bull market. It's far enough away. Now, if we were into like a choppy or weak market or a bear market, you can start the month with monthly hedge pressure literally right there. And it's the same effect, but it can be actionable every single day that month. So it just depends. When you open up your new month, we always say that's the newest, highest visibility you have in the market. And as we open up the new month, we're still crammed up really solid into bull territory, which is why the market is like slowly trading down because it's still bullish enough to prevent a crash. So we're seeing this effect, and therefore monthly hedge pressure is just not going to be actionable for a while. But whenever you are trading near it and you are close to it, then you start to consult this yellow line. You see it's pegged out right at the top because all stocks are trading above their monthly hedge pressure right now. You can put any stock in here and you can see that all the big ones, you're just trading above monthly. And that just means this is just a result of the residualness of the bull market. Like Disney's way above its stock, and I don't know, Amazon, put some tickers in here. Amazon's there. Apple, somebody asked Apple. See how that works? Okay, cool deal. And the stocks are comfortably bullish-ish still. Why would price bounce? There's only one reason price moves, and it's because there were buyers there. And this is the basic principle of all markets. Don't ever think it. Market makers, I was watching Instagram today. Let me see if I can find it. There are so many idiots that make trading content. It just blows my mind. Somebody was like, and I guess these people just Google stuff. There's like some kid trading, and they buy views or whatever. They're sitting there and it's like, so markets are moving up and down. And price moves here, and there's this entity called market makers. They're the ones moving price to squeeze you out of your trades or something. What a fucking moron. Who's gonna pay for this guy's trading course? Jesus Christ. Market makers move price to squeeze you out of your trades to trick you. First of all, market makers are computers. Trade. Hold on a second. Wait, where'd my glasses go? Secret Illuminati entity designed to stop you out of your trades. They watch what you do, and then when you go long, they just move the market against you and you lose. No, you just lose because you're a bad trader. It's like market makers themselves are moving price to look for buyers and look for sellers, and that's it. You lower price to look. They bid. They first of all, they're just betting on bid and ask. They're putting a position on the bid. They're putting a position on the ask. That's what a market maker does. Price moves based on the real buying and selling. They're bidding the market and asking the market. And the net sum of all of them is setting the depth of the market, which allows buying and selling, of natural buying and selling, to be buffered against natural movement. If they want to hold the market still, they just keep throwing orders on the bid and ask. If they want the market to fall, they just remove their order and make it thin and let sellers clear out tiers. But the way markets move is by the thickness of the market against the resistance of real market selling, buying and selling market orders. So if I set a bid at 1 and somebody sells at 10, sells 10 to the market, and I set a market at 1. Sorry, can I hear the music? There it is. Then I see I have 9 more to make up. Well, I can therefore immediately quote any price I want for the remaining 9 if I'm the only buyer. Therefore, I can lower that price and buy cheaper because I'm the bid. That's how market making works. I didn't lower the price because I wanted to stop anyone out. I lowered where I'm willing to buy, and somebody sold to me at that point, and that's what sets price. That's how market makers. I'm not moving around to chase someone's stop. So to answer your question, Chase, why would price bounce off the bottom? Is because when market makers are lowering the bid, they're lowering the bid until when they're buying attracts other bulls, and then the bulls start pushing it the other way. When price is lowered, bulls come out. When price is raised, sellers come out. So buyers, when market prices are trading lower, buyers step in. When market prices are trading higher, sellers step in. And dealers are adjusting their bid and ask to try to match where the market will be liquid. Maximum liquidity is minimum risk for them. And so if markets bounce, it's because buyers stepped in. That's the only reason markets ever bounce. It's not manipulation. It's not trickery. It's because at that place, buyers stepped in. It's either, and buyers are one of two flavors, either shorts covering or longs entering. So yeah, exactly. Their $1 billion algorithm is designed to take your $40 stop loss. And so like the way, again, and people think that like market maker is one person that's going to set the price and move price around, squeeze people out. It's a net. The market making is a group of banks that are competing against each other. But like I said, they have the net, they have rules they have to follow, which they all do to stay in the game. To do that, the exchange gives them rules, and they all have the same goal: to make money. They're all trying to make money against each other. There's no collective that's going to squeeze out your stop. He was like, here are my 5 steps to avoid being tricked by the market makers. I'm just like, oh my God. Video had like 6,000 likes, and I'm just like, maybe these people just buy these views. There can't be 6,000 people that would watch that and go, oh my God, he's right. The funniest stuff exists these days. But at the end of the day, the reason, the answer, Chase, can explain the reason why price would bounce because buyers are found. And you can't predict that. Nobody can predict that. The market makers are lowering their bid to allow sellers to sell to them cheaper with the hopes of other buyers stepping in and absorbing that responsibility. So an example is market maker is a buyer of last resort. Think of it like this, right? I have a really big, thick wall right here. People are going to sell to me. All right. And then my wall is 10, but somebody sold 100. Now I gobbled up 10 because I was already there. And now I get a split second because I'm the market maker. I fill that order. Pretend I'm the only person there that exists. I have an order of 10 on the bid and 10 on the ask. And when you submit a market order to sell 100, and it's only you and only me and there's nobody else, I have to buy the other 90. And I get to decide where I want to do that. Now, clearly, I'm not going to buy higher because I'm going to be losing money. You're willing to sell to me. I'm the only buyer, so I'm going to lower where I want to buy. Right? If I lower the price a little bit lower, then I bought it at a cheaper value. The lower I go, the cheaper I get it. But the problem is, the lower I go, the probability goes up exponentially. They start triggering stop losses, which can force more sellers to come into the game. So dealers can lower the price enough to get it cheaper, but they're going to lower the price because they want to attract enough buyers to offset the cascading margin calls that'll come if you create a snowball from stop losses. So it's a sweet spot. Like I said, envision this again. I'm the only dealer in town. Somebody sells to me. I'm going to lower the bid to buy. The lower I go, I'm just going to draw an uptick. That's how many stops I'm going to trigger. If I go lower, I get a better deal, but I trigger more stops. If I go even lower, I get an amazing deal because I gobble those shares up at nothing. Then I trigger a whole bunch of stops. And therefore, the higher the amount of stops you trigger, it circles back around and bombards you with further selling, and then you crash the market to zero. Does that make sense? Now, the other thing is that when you lower the price, these are stops. So as you see, if I lower it very drastically to catch that one bid, I'm going to trigger a ton of stops, which is going to circle. The higher the stops, that's more selling pressure that comes. So I'm going to draw arrows back at me. But also, there's an added effect is that a lower price attracts other buyers, right? So as I lower the price, there are more buyers. It may not be exponentially more buyers. They may not snowball on each other. But at some point, you lower the price too far, you're going to trigger more selling than buying. If you lower the price just enough, you're going to attract more buyers than sellers, which is what you're trying to do. Dealers are going to lower their bid to where they buy so they can attract buyers as well. That offsets the stops that they trigger. Do we all wrap your head around that? That's how market making actually works. If you lower price too far, then the amount of buyers you trigger do not offset the amount of selling that happens, which is why every time somebody sells to the market, it doesn't just fall to zero. Because then, so are we always buying and selling with market makers? For the most part, these days, yes. Almost every single order that goes through is routed to some order routing facility, like a Citadel or something. And they distribute your order free. You trading against me on the level 2 is like rare. I would take a guess. It's hard to know these metrics. I'm gonna take a guess. The upper 90s percentile of every trade passes through some middleman, if not all of them, these days, because they're allowed to cut the line in the bid and ask. So even if you were on the level 2 here as a seller, and I longed to the level 2, chances are somebody jumped in and grabbed my long in between the prices, and then they sold to you. So even though you might be first in line on the bid, dealers have the added bonus of being able to cut the line. And they usually do because they can trade the middle. And Jared is saying yes. And I would, if anybody has a little more information than that, I'd love to hear it. But the answer is yeah. So the only reason price moves up or down is because buyers step in or sellers step in, and that's it. So prices moved there because there were buyers there. And why were there buyers there is a complete random thing. Nobody knows why people decide to buy. But does everyone see, before I finally cut out of here, just how fucking cool resilience is? I don't know if y'all want to rewind the stream and somebody make a graphic of what I drew today. But resilience said from here to here, market moved there. Then I say right there, I'd exit my long. Didn't I say that? Because res didn't come positive. I need some more cough drops. My cough is seriously never going to go away. I never know what's going on here. That is cough since my brother's birthday. We're smoking cigars and drinking scotch, and I got a cold, and it's just been tickling my throat ever since. So Jared says, depending on your broker, you can direct route the order to the exchange, but otherwise they'll sell the flow. How brokers make a lot of money, right? What Jared's talking about is a principle of you can sell order flow. Robinhood does it. That's how all these brokers do it. That is direct to call them what DTM, I think, direct to market brokers, that you submit your order away from the, you directly submit to the exchange. But even when you submit directly to the exchange has employed market makers for the exchange. So you might avoid the Citadel in the middle who sells your order to the cheapest bidder, but you still succumb to the market makers jumping the line still. So even direct to market, you're not directly selling or buying to another trader. You still hit a liquidity provider almost every time as well. Your order is just not middleman and passed around like the town bicycle before it's actually filled. Selling order flow is big businesses for trading platforms. We don't do it, by the way. We don't sell your order flow. Actually, you don't trade through us. You trade through EdgeClear. I don't know what they do. We don't. If Rockseer was a broker, we probably would. It's huge money. Everyone does it, but we're not a broker. I don't know. On the trader's side, the losses are minimal. It's like you lose pennies from that behavior, and it just racks up tens of trillions of times a day, and everyone makes money off of that. It's just a thing everyone does. There's an ETF for gold. There is GLD. Ooh, all right, guys, I got this. Ready? Somebody do me a favor. Y'all put this together and send it to me. I will add this to the platform this week. You see in the risk interval section for futures, I want somebody to go out there and make a Google sheet, share it with the members and say, hey, we need everybody's help. Give me your favorite ETF that you use for this futures contract and just start it for me and I'll fill in the rest of it. How about over here, you'd have equivalent ETF for, as Solomon is stating, for each of these that you can. We're about to make the risk interval customizable, by the way. You can add which ones you want to look at, take which ones. So that over here that you would see that you have DIA for YM and UVXY for VIX and, you know, whatever for whatever. USO for oil, right? GLD for GC. TRS coming in clutch. Let's see it. You've got something like that. Let's do it. Yeah. Maybe in the member tools or something. We call like suggested ETF to watch. Yeah. But to answer your question, so to go back to what Chase was saying, what makes it so hard, brother, is that like the idea is that why is the market going up? Because there were buyers here, or they're raising price to look for sellers. They're raising their ass to look for sellers against the buyers. Either way, markets go up to look for sellers, markets go down to look for buyers. So when they pivot, it's because one side outweighed the other against the depth that's currently there, against the willingness of where dealers do want to position themselves. So they're always trying to position for maximum liquidity. So they're not raising price or lowering, they're raising their price or lowering their price to squeeze out your stop. They're raising and lowering their price to try to allow the market to trade in the most liquid zone, which basically means the most buyers and sellers against each other, which means the market makers are the most happiest. It's a real word, most happiest, because they have to do very little action as traders are doing all the risk, and they're just cutting the middle all day long at no price movement. A perfectly balanced flat market between a bull zone and a bear zone, where dealers are winning every second of the day, option sellers are winning theta every second of the day, is the optimal design for market makers to balance and keep markets there. So liquidity pocket, bulls are losing, bears are losing every moment of the day. All the calls and all the puts are just making them money that they sold. Price wiggles up and down based on the randomness of buyers and sellers stepping in there. Other than that, dealers are not incentivized to squeeze out your stop. They're incentivized to attract more traders to the game. And that's why Mr. TikTok homeboy is a complete doofus. Instagram homeboy, because that is not what they're trying to do. And on that note, I'm going to call it quits and walk out for the day. Easy to read market today. It's like completely super easy. Feel free to check out Rocket Scooter. We have a $35 a month for 3-month trial. You can check out all of our tools, indicators on the platform itself, and have platforms, data feeds, all of that. At your disposal. Get away, play with that, and have a look at what we do. Learn everything in the boot camp. Come to all the training sessions. Get all these cheat sheets. Really get your hand on what we do here at the market. It's a whole different style to see the market. That's where revolutionize the game for everybody. Once you check it out, $35 a month for 3 months. Just try it and quit any time if you don't like it. I bet you'll love it. Yeah, like seriously though. Stop letting people on TikTok and Instagram just Google a word and then talk about it. It's very bad information out there. Don't let it be part of your training, man. Hopefully you guys learned something good. You guys kick ass. Love y'all. We'll see y'all later. Adios. Discord link is below, by the way. Join the Discord if you want someone to talk to you for more information about it. Just join there. Send me a message. I'll be here today. Goodbye.